Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today for today's podcast. It is Thursday, August 22nd, 2024. And tomorrow we get to hear a little bit from the Fed Chair Jerome Powell from Jackson Hole, Wyoming, regarding the economy, what they expect to do in the next Fed meeting in mid-September, regarding the path of interest rates. A lot of market participants are pricing in rate cuts, which we're very excited to finally see that likely to happen here. So that's going to be a big part of today's show. So a lot to talk about for sure as we're wrapping up earnings season here as well, and in the middle of a presidential election all at the same time here. So a lot of different things to talk about today, as we'll get into a little bit of all that sort of stuff. But yeah, we'll have to wait and see what happens tomorrow. Really, I mean, tomorrow is the day as far as Fed is concerned, and after that, we get a whole bunch of other data, which I'll talk about here today as well. So, plenty of things for us to get into. But before we get into anything, I'm more into getting into this football season that's going to be starting here in Cincinnati after tonight. So tonight we get our last preseason game with the Colts. I'll watch that this evening, and then 2 weeks later we get to watch the games that matter.
I can't believe it's already here. I know you're excited for it. Um, as much as I love the NBA, that's football is definitely your thing. So I'm excited for you. I'm excited to have one more thing to talk about. That's not who's going to win the presidential election and when is the rate cut showing up. So
For sure, because that's going to dominate headlines. We're going to have to talk about it, unfortunately. Um,
yeah,
but it is what it is. But I am happy to have something else to distract us from all this craziness that we call politics. And I'm looking forward to NFL football getting kicked off here. So excited about that. What's going on in Louisville, man? Anything exciting today?
I wish there was. No, we had a very fall like past couple of days as far as weather and temperature goes. So that's been really nice. My dogs enjoyed being able to go outside a whole lot more. And I've certainly liked having more outdoor activity since it's not, 97 degrees with 105-degree humidity
Oh
or
yeah,
heat index. But unfortunately, it looks like that's coming back this weekend. We got a little teaser of it. And then, the weather's like, not until October are you getting this again. So,
yeah. It happens here in the Midwest, but we'll roll with it. We all chose to live here.
yeah.
Um,
Yeah.
but yeah,
The Ohio Valley in all its glory.
that's right. That's right. That's it's just something that we're going to be dealing with here. But yeah, a lot to look forward to, but a lot to talk about today. So we might as well just go ahead and kick it off here, Ed.
Let's do it.
I mean, I can
Fire
talk
that
about
pink
fantasy
cannon.
football. Yeah, that's right. I can talk about fantasy football and all this stuff. But yeah, we might as well just hop into the stuff here that we have for the viewers.
Let's
And we
go.
appreciate you watching the show. If it's your first time catching us, thank you. Don't forget to like and subscribe to the show. That way, when we drop this on YouTube every 2 weeks, you'll be notified. And why you want to be notified is we pretty much try to cover what the news is talking about, the headline stuff, but then go a little bit deeper, because the one thing that we probably can all agree upon is that the news does a good job of bringing something to your attention. Usually that something is a risk, something to be concerned about at the very least, or maybe even outright fearful of. And the reason why the news does this, of course, the news understands human beings. Believe it or not, you can get a PhD in this topic called behavioral finance these days at every major university. And this study is fascinating. It simply just shows how human beings uh, make decisions under stressful circumstances. And what this study has found is that we as humans, we feel losses twice as much as we feel good about a gain. And that's the reason, one of the many reasons why the news tends to placate to the fearful side of human emotions, because it impacts us, it engages us twice as much as good news. And that's what keeps our attention. That's how they're able to sell marketing ads. So I'm not knocking the news' business model. It is what it is. They're doing a good job at it. But the one thing that we try to do here at this show is say, hey, yeah, this is a risk. This is something to maybe be concerned or fearful of potentially if this happens. But there's also a precedent. Outside of the COVID-19 pandemic, where the whole global economy got shut down for an extended period of time, there's always been some sort of historical precedent, meaning that other investors have dealt with something very similar. if not exactly the same. It's probably happened more than one time in the history of the market. And when we look at that past history and we understand how human beings have behaved prior circumstances that are very similar to what's going on today, all that does is put probabilities in your favor. Now you can start to allocate resources to places where you're most likely to benefit from. And of course, past performance is no guarantee of future results. And of course, investing involves risk, including risk of loss. But that's what the news does a bad job of. It's giving you that historical precedent. We want to bring that to your attention here so that you're more informed, you're less fearful, which is one of the most important things that Warren Buffett talks about is reasons why individual investors that do it themselves do not achieve the results they're looking for consistently is because they, one, have no control over their temperament, meaning their emotions. This is how we get control over our emotions here for our customers at Shepherd Wealth Management, is bringing that historical precedent to their attention. That way we can say, okay, with a fairly high degree of certainty, here's what the probabilities are for the market and the 11 sectors that make up the S&P 500. Now, if we're looking at small caps, industrials, and tech, like we are right now, well, what are those positions that might make the most sense for us to own in an asset allocation, given that that's where we think the highest probabilities of returns are in the equity markets for the next 6 to 12 months for our customers? That's the advantage that we kind of bring here for our podcast, as well as the advantage that we bring for our customers at Shepherd Wealth Management, providing this historical lens. Outside of the table stakes. Of course, the fundamentals matter for corporations, their executive team. Of course, technical analysis matters if you're looking at things on a shorter duration, trying to figure out maybe buy, sell, hold time frames, etc. Those are table stakes. Of course, you have to have the knowledge, the education to understand that information and read it appropriately. But then, what are you going to do with that? Everybody and their brother on Wall Street is able to do that. The advantage that we try to bring to the table is providing that historical lens so we can get the probabilities in our favor at least as consistently as possible. So that's the reason why you want to tune in and stick with the program here. So as we wrap up earnings season, just to kind of kick us off here with some data, we got 14 companies reporting in the S&P 500 this week. Of the 476 companies that have reported so far, that's 95% of the S&P 500. 82% of companies are beating their estimates, and those that are beating their estimates are beating by a median of 5%. So really strong, corporate earnings. In addition to that, when we look at forward earnings of corporations, so there's an article from Bank of America, their wealth management department, and the article headline here is on August 8th of this year, of course, and the article headline is a market correction coming? So we had quite a bit of a sell-off, of course, here very recently, and we're going to talk about some of that. We did that in our last podcast as well, talking about some of the jobs miss data and why that was inaccurately accounted for, in our view, by the Bureau of Labor Statistics regarding the hurricane that happened in Texas. I think that that's going to be resolved here on September 6th. We get our next monthly jobs update. But this is the headline here for Bank of America: is a market correction coming August 8th? So they talk about all the reasons why they don't believe a market correction is coming. I'm actually going to talk about some of that stuff here in just a little bit. But one of the reasons why is corporate earnings and stock valuations. So second quarter earnings is being wrapped up, as I mentioned here, pretty much this week. There's not very many companies left to report, although we have a huge one on August 28th, that being NVIDIA. So after this week, really the last thing that we're looking forward to from an earnings standpoint is NVIDIA. That's going to be on the 28th of August. We're very excited about that. Wall Street's very bullish on their earnings, and a lot of reasons to be excited about their earnings. So we'll have more to say about that as we get there. But one of the reasons why this article talks about there not being a recession coming, and I agree with this, is that corporate earnings and stock valuations. So they're growing at 11% pace compared to second quarter 2023 earnings. So despite all the challenges, that you've seen and probably seen in the headlines, corporate profits have been extremely resilient. And that has everything to do with the fact that, okay, well, how do we get corporate profits, at 11%, growth rate going into next year, which is really strong? How does that happen? Well, you have to have an unemployment rate that's essentially full. And right now, yes, unemployment has grown from sub 4% unemployment to where we're at right now, which is 4.3% on the unemployment rate, but that's still historically low. That's what we would define as maximum employment from a Federal Reserve perspective. And when human beings, when Americans have jobs, they consume. That's what makes up this economy. 70% of the United States economy is consumers consuming goods and services. So as long as the unemployment rate doesn't spike much farther from where it is today, then you really can't argue much about this upcoming quote unquote recession that had so many investors worried over the last couple of weeks. And I'll get to why they were worried and what the outcome was and all that sort of stuff here in just a little bit. But that is exactly um, what investors need to keep in mind as they're going through, the news headlines that get hit on your phone throughout the day. I'm sure a lot of it has to do with geopolitics right now, and of course, that is, in my view, the biggest concern for investors should be geopolitics. It shouldn't be the U.S. political election. It shouldn't be corporate earnings. It shouldn't be what the Fed does with interest rates, et cetera. All of those things matter and do impact markets. There's no question about it. But I think we know the answer to a lot of those questions. We don't know who's going to be the president, but we also know that whoever the president actually is, historically hasn't really impacted the S&P 500 one way or another all that much. Certainly, certain sectors of the S&P will benefit more than others depending on who's in the White House. But overall markets, history would say not a huge impact. In addition to that, whatever happens in the election in November, the outcome of that on November 7th, that person isn't going to be in the seat for a couple months. So they truly can't even do anything to impact policy or overall, corporate America. So we're going to look at, things like what can really impact corporate profits. And certainly that's going to be things like taxes. That'll definitely play a big role in 2025, depending on who the actual person is in the White House from a policy perspective. So we'll talk about all those different things, but long and short of it is, if you're going to go through the remainder of the year with really strong earnings, an unemployment rate that's basically full employment, and you're about to have the Federal Reserve reducing interest rates for the first time in quite some time, all this is a really good backdrop for U.S. investors. Now, the geopolitical risk that I mentioned earlier, it should be the number one risk because, of course, there's no control that you as an investor have over the decision of war or not. But more importantly, regardless of whether you're super diversified, you're really concentrated in your portfolio, you could try to diversify as much as you want. You cannot diversify geopolitical risk away, right? That just is something that every investor has to deal with for now and for always, as long as you're going to be participating in the market. There's no way to diversify around geopolitical risks. So it is something that you have to be concerned about. But outside of that, I really don't have much of a concern with, being fully invested in the marketplace at this time. It really just depends on your risk tolerance, of course, your time frame as the individual investor, and the goals, of course, that you have for your portfolio itself. So if you don't need your assets anytime soon, you're like myself, you're investing for the future. If you have a longer time horizon, allows you to accept a little bit more risk. And that's exactly what we're doing here for our customers, and we're positioning accordingly based on market probabilities from a historical perspective. Now, I do want to talk a little bit about some of the volatility that we've experienced here recently, as we believe that the summer low was actually on August 5th. Now, a couple of days before that, we got jobless claims data. And we talked about this during our last podcast in pretty good detail. So we had August 2nd, brand new, fresh jobs data that came out, and it came out below consensus expectations, meaning that the market was looking for 185,000 jobs. Number came in light at 114,000. The headline risk that we talked about in our last podcast, as if you remember, was the news outlet took that jobs miss and said, hey, the Fed has waited too long to reduce interest rates. They've caused a recession in the jobs market based on this data.
Yep.
One jobs report. Therefore, there's going to be a recession in the market because people are going to start to get laid off, right? And that is a huge signal for recession. If you're looking for one piece of data to help you understand recession or no recession, is corporate America laying off a bunch of workers? If the answer is yes, then there's usually a recession that follows that. And right now, you're just not seeing a bunch of corporate headline layoffs. But that's what the news extrapolated, right? And that's where we saw this massive sell-off across the entire stock market. All sectors were affected on August 5th. And the reason for that, we got some jobless claims data that came in much better than market participants had expected. And we rallied off of that August 5th low. Now, the interesting thing is we talked about fundamental technical analysis at the beginning of this. So from a technical analysis standpoint, even though that was a very painful drawdown over just a couple of days, we're talking like 3 or 4 days, 10+% drawdown in the S&P 500. I'll give everybody the numbers here in just a second. But we never actually dropped below the 200-day moving average on the S&P 500, which I thought was super important. Basically, all the major averages, Dow, Russell, NASDAQ, S&P, they all basically came down to their technical line in the sand moments and never really breached it. So that was encouraging from a technical standpoint. I mean, literally, small caps went all the way down that 200-day moving average on August 5th, bounced off of that, and has not broken down through that since. So all the technical analysis is still lining up well for the back half of this year. We got a bunch of data coming out. Of course, we got the Democratic National Convention going on right now. We're already getting some. Yesterday, we got the Fed minutes, which were all positive. There was a lot of Fed governors that were asking for and wanting to actually cut rates on July 31st. We thought here at Shepherd Wealth Management that should have happened, a 25 basis point cut on July 31st, but it didn't. But it is teeing up tomorrow, which is Fed Day. There is no rate decision whatsoever, but the Federal Reserve governors and the Fed chairman himself, Jerome Powell, are in Jackson Hole, Wyoming, and they're meeting both today and tomorrow. You'll hear from Fed Chair Powell tomorrow morning, I believe about 10 o'clock Eastern Standard Time, and he'll talk about their upcoming meeting in September. So here's what I expect him to talk about. After tomorrow, of course, next week we have pretty big earnings release from NVIDIA. He's not going to talk about NVIDIA, of course, but that's going to be a big market impact kind of day. It's based on their earnings outlook and their guidance for the future. But they're also going to get, as I mentioned, September 6th, just a few days after tomorrow, a very fresh monthly jobs report that should completely negate the jobs miss from last month. Again, the reason why I thought that there was a huge miss from 185 jobs expected to 114 reported was that the state of Texas dealt with a pretty big hurricane at the very beginning of July, where this data was collected for the month of July, jobs data for Americans. And that 1.3 million Texans that were impacted by that hurricane, didn't have power. That meant businesses were without power also, which certainly affected the labor market statistics, but unfortunately was not highlighted by the news in any way, shape, or form, which caused this massive sell-off. Now, I don't know why the news, as the news is defined, they're here to do research, not just say, hey, here's what to freak out about. Like, hey, here's something to maybe freak out about, but how about we have like Bob and Jen back here in the back do some homework as to what does history have to say about events like this? And is there a reason why we may have had that, jobs missed to the magnitude that we did? But nobody did any of that. Unfortunately, even though the Bureau of Labor Statistics publishes all this information, and it's very easily to get it from their website. And it's pretty obvious to me when you actually look at the state of Texas job numbers. And this is what we spent so much time on in our last podcast, which is why you want to be a viewer of the show. You're going to get a lot of the stuff that the news doesn't simply bring to your attention. And the fact of the matter is there was two categories in that last month's jobs report for the state of Texas that was a huge, huge outlier. And that would be has a full-time job but not working due to weather. That was over 1 million Texans in that report. The 10-year average that they typically see for that category every month is somewhere between 60 and 225,000. So huge outlier statistically, over 1 million. And the other one was has a full-time job but working part-time due to weather. That was more than 420,000 Texans. The 10-year range for that typically is somewhere between 10 and 60,000. So again, huge outliers. That's the main reason why we missed. But we'll confirm that on September 6th. So you get the Fed speaking tomorrow. You get Nvidia earnings after that, August 28th. You have September 6th, which I expect to be a very good jobs report. Basically, completely throwing cold water all over that July jobs miss that we saw prior month, again, due to the state of Texas. And then after September 6th, we have a Fed meeting. So the Fed is going to meet, mid-September, and the expectation right now, essentially 100% probability of a 25 basis point cut. Market's pricing in at least 100 basis points or 1% of interest rate cuts. I don't think the Fed goes that far. I think the market is overcorrecting in one way. So just a couple weeks ago, before we got that jobs report miss, the market was only pricing in 1.5 interest rate cuts. Now they're pricing in 5 rate cuts. So it's very likely that there's somewhere in between that. My view has been all year long that we get 3 25 basis points cuts this year. I think we'll start to see that September, another 25 basis point cut in November, and the final one in December, and they'll continue that trend, into 2025. And the Fed minutes kind of give you some hints as to, most Fed folks want to stick with the 25 basis point reduction. There is some rhetoric right now as to whether or not they should do a 50 basis point rate cut. Either way is good. I just want to see them start to do it. I don't know if they necessarily have to do 50 basis points. I could definitely make a case for why they should, but I could also make just as easy as a case as to why they, can hold off on a 50 basis point rate cut for now. But the reality is, and what we're seeing in the Fed minutes that came out yesterday, and what we're seeing from some of the Federal Reserve people that are speaking right now from Jackson Hole, Wyoming, before Fed Chair Powell speaks tomorrow, is that the risk of labor and inflation are now in better balance. And that means that the Fed should now be forward looking. They need to be less, quote unquote, data dependency. Most of that data, as we've talked about on this show, like every time we do this show, how backward looking that data is that they tend to look at. Now the Fed should be much more forward looking, saying, okay, what is the actual impact of our decision making from here on, not only inflation, which has been the focus, but also the jobs market. And I do not think that the Fed's looking to destroy jobs by any means, given the fact that inflation's fallen so much from last September. So last September, we were at 9% inflation. Here we are today, under 3. You're looking at headline, CPI, and the Fed's favorite measure of inflation being core PCE, which we also get next Friday. So the Fed's going to have fresh inflation data, fresh jobs data going into their mid-September meeting. All this, unless the data somehow spikes on inflation, or somehow the labor market just collapses between now and mid-September, I think you're going to see a 25 basis point cut in September, continuing November, December for the rest of the year, which is really, really good for certain sectors of the market. Now, we've talked about these sectors all year long. Small caps benefit from interest rate cuts. Industrials certainly benefit from rate cuts. Technology is a beneficiary of that. Financials are a beneficiary of that. We need 6 million more homes in this country. Right now, in my neighborhood in Northern Kentucky, they haven't built a home here really since I've been here, since 2013. So over 10 years. And now they're popping up new homes right now. They've actually cleared out acres of land. Multiple acres of land that has not been touched for the 10 plus years that I've been here. Now they've cleared it all out, and there's plenty of room for at least 50 plus homes. Maybe 100 plus homes. I'm not 100% sure because I haven't walked all the acreage that they cleared out. But all that is spelling, hey, interest rates are coming down. And when interest rates come down, demand for building, constructing, investing, all that stuff goes up because the cost of borrowing money is lower. It's lower for both consumers on their credit cards and their home equity lines of credit. It's also lower for corporations as they go about making investments in their business or building out infrastructure or actually building homes. in this example. And I live, in northern Kentucky, just outside of Cincinnati. If they're doing that here, they're probably doing that in Chicago. They're probably doing that somewhere in Florida. They're probably doing that somewhere in Texas, et cetera, et cetera. So all these things are very, very bullish for investors. However, you still have more than $6 trillion still sitting in cash. Even though the market's up double digits this year, it was up double digits last year. There's as I mentioned, a great reason, a lot of reasons to want to be very bullish. If you are a investor with any length of time in your time horizon at all, but you still have record levels of cash. And a lot of people are talking about market valuations, and maybe we're only about 1% from the S&P's all-time high. Well, the fact of the matter is the S&P is trading at 21 times forward earnings as we're sitting here talking right now, which is not outlandish. But if you take out the 7 largest companies on the planet, the Mag 7, if you will, you got the market PE of about 16, 17 times, which is not historically expensive. It's right about average. And in addition to that, I think the main reason why individual investors are actually not participating in the market has to do with, again, their fear of the outcome of the election itself. You have 2 polarizingly different candidates with completely different agendas. And I think that a lot of investors are putting a lot of stock in, this actual election itself. And I get that it's an important election, and there are different views on how to run corporate America, the economy, and different policies and programs for sure between these 2 candidates. But the history of the market suggests that whoever wins, the S&P is going to average about 10 regardless. If you go back over every presidential election since the beginning of, presidents in this country, George Washington to now, when Democrats win, the S&P is up about 10.1%. When Republicans win, it's right at about 10%. So you can't argue the fact that history says, regardless of the outcome of election, the markets overall will be fine. And certainly there will be sectors, as I mentioned, that benefit and some that suffer, depending on who wins. But overall, markets are fine. So for the investors that are sitting on the cash out there, clipping 4.5, maybe you're still getting a little bit of 5%. All that's about to change here in just a couple of weeks. So as soon as they reduce interest rates, your money markets are going to reflect that. So investors are going to have to do something with that. I think a lot of that money starts to flow into markets as we confirm. I think investors also want to hear Jerome actually say, we're going to cut rates. We're going to do that in September. I think they want to start to hear that. Now, if you look at different polls, you see some having Vice President Harris ahead. If you look at things like a Wall Street betting polls, which isn't as talked about, this is basically Wall Street making decisions with money based on their forecast of who's going to win the election with 76 days or whatever it is out there. They have Trump with a slight advantage, but that's, take that with a grain of salt to Wall Street. They probably don't want regulations, and they probably don't want corporate taxes to be any higher than what they already are right now, et cetera. So we're all going to have to wait and see. I don't want to make decisions, bottom line, for my customers based on the outcome of any election. It doesn't matter what the election is at all. What I want to look at that gives us an advantage here is, where's the market going? Where's the puck going with whatever it is? Is it the election? Is it interest rates? It should be all of the above. And the reality is, regardless of the outcome of the election, what do you have? You have the Fed cutting rates, which is still really good for Bitcoin, small caps, financials, industrials, and technology. That doesn't change regardless of the outcome of the election. What does change with the outcome of the election, starts next year in 2025, which is historically why you see markets being very volatile, acting very finicky leading up to an election. Typically happens late September, all through October into November 6th day. And then after that, historically, regardless of the outcome, investors are so happy that that freaking election is over and that uncertainty is now gone. You almost always see a nice rally right into the end of the year, again, regardless of the outcome of elections themselves. Now, although we would expect some sort of bump for Harris's polling numbers, after the DNC convention is over here, this week, and she'll be speaking herself, I believe, today, if I'm not mistaken. Is that correct? I think she's lined up for this evening as far as her comments are concerned.
I believe so. Yeah, that this is the day that I don't know if she's already officially accepted the nomination, but she shows up and says, "Yeah, sure, I'll do it." That kind of thing.
Yeah.
Lays out all her
Yeah.
policies that she's got so far. That kind of stuff.
Oh yeah. So there'll be plenty of news headlines tomorrow, right? So you're going to get the Harris headlines and you're going to get Fed Chair Powell headlines. So I'm going back a couple years, 21, 22, and 23 at Jackson Hole. So in 2021, the Federal Reserve was pretty dovish in their remarks, 2% after his comments. In 2022, remember, this is when we're fighting inflation, and he was very hawkish. Matter of fact, the Washington Post headline um, for Fed Chair Powell's comments at Jackson Hole in August of 2022, the headline was "Markets sink after Powell says fighting inflation will cause quote some pain." And we saw a decline of 8% on the S&P, and it continued to decline throughout the summer months there between August and October. And then in 2023, so last year, markets percent. The headline news after Fed Chair Powell's comments last year, where Wall Street closes higher after Fed Chair Powell delivers a Goldilocks speech. So I expect more of what we got last year. Matter of fact, I think that the market accelerates to the upside in a pretty big way if Fed Chair Powell can get off the data dependency conversation. So I hope to not hear anything at all about data dependency. I think it's fine that if he says something to the effect of, yeah, based on what we've seen over the last 4 months from a data standpoint, risk or more balance with labor and inflation, and it now starts to make sense for us to clear a path for rate reduction beginning our next meeting in September, as long as, and this would be the caveat, as long as the upcoming data, September 6 jobs, inflation news that we get next Friday, et cetera, as all long as all that stuff continues to line up the way that it has, and that gets him off the data dependency conversation and makes the Fed appear to be much more forward looking. So that's what I hope to hear. And that to me would lead to a pretty big rally, post the meeting tomorrow, which I believe will kick off right about 10 o'clock Eastern Standard Time. Now, I do want to talk a little bit about the most recent volatility. So late July 31st through August 5th. So it's like a week. We had some poor jobs data that we talked about, but we also had this a huge issue over in Tokyo regarding the carry forward trade. Essentially, they increased their interest rates by 25 basis points. You probably had a lot of people using leverage. Well, again, when interest rates go up and you have leverage, whatever it is with investing, margin, credit cards, et cetera, the cost of funding automatically goes up, and you had a lot of people covering that trade. So it's, again, why you saw a big sell-off over in the Tokyo market and why it all basically recovered within a day and a half. However, here in the United States, uh, did not have such a quick recovery. But over that week, between that jobs miss, which happened again early August, and then again the Tokyo fallout over that same week, you saw the Russell 2000, the small cap index, down nearly 10%. You had things like financial sectors down almost 7%. You had all the FANG stocks down about 9%, regional banks down 10%, just this huge sell off. And then right after the August 5th low, which I believe is the low for the year, you saw a snapback rally. So all the FANG stocks, got all of the losses back plus some. They were up almost 11%. The S&P 500 rallied 7% after losing 6% over the prior week. But the small cap Russell trade has only come back about 5%, only getting about half of what it has received. I mean, the S&P going down 6, then getting back 7, all within a couple of weeks is pretty astounding. You don't typically see that very often, but it is fairly typical in a bull market cycle, which we're certainly in without any debate right now. So corrections of this magnitude, that 5 to 10% that we saw, not all that uncommon during a bull market year, but to see that happen in such a short span of time is what really made things feel way worse than what it actually was, and I think still has a lot of investors shaken, given how violent. You saw the VIX actually spike above 60. I mean, we haven't seen something like that since the actual pandemic. Um, March of 21. So this is just certainly a wild week for investors to be a part of. And the answer really here is let's just get through August. If you're an investor with a long time horizon and you've dealt with this whipsaw you saw the last 2 weeks, just kind of make it through August. August is seasonally a weak month for investors. Catalyst here that I think are very, very good for long-term investors, even those with a shorter time horizon here, given that you should have Fed Chair Powell speaking very dovishly tomorrow. It should spark a rally in the markets. And if he's not data dependent, should start a pretty big rally leading into NVIDIA earnings, which I think continue to carry the market into September. You get the jobs news, which I think will certainly reflect really good numbers, given that there's no hurricane issues. I know that there's wildfires and stuff going out, some parts of the West Coast here, but they're certainly not making national headline news, causing super major problems like that hurricane did for millions of Texans for a couple weeks there. So a lot of good reasons to be an investor right now, in my view, with the Fed cutting rates and looking to cut rates throughout the remainder of this year and into next year, all adds up to a pretty good backdrop for investors. And in addition to that, you also have history on your side. And we mentioned this in our prior podcast, maybe a couple podcasts ago. But if you look at the S&P 500 since 1950, and the first half of the year is better than 10%, just like this year, meaning the S&P was up more than 10% in the first 6 months of this year. Well, since 1950, that's happened exactly 23 times. And the second half of all of those years since 1950, the market was positive 83% of the time, and the market averaged darn near a 10% return. So I'm very bullish from a historical perspective as well. And on top of that, the only time since 1950 that we actually didn't see, the market higher, again, 83% win ratio with an average of about 10%. The only times that did not happen, where we had first half of the year plus 10% and the back half didn't give us, about the same, is during the Paul Volcker years. That was the, late 70s, early 80s, where we took interest rates to 20% on the Fed funds. The most we've ever seen up until this past rate hiking cycle last year. And obviously, we're not in a Volcker era, and we haven't taken interest rates on the Fed funds that high. So I think the probabilities from a historical standpoint are in your favor. And again, I know August has been rough. It's been volatile. We just talked about the volatility of the markets here in August, and August historically not being a very seasonally strong month for investors. It does not mean that you should be shaken out of your portfolio. What it does provide you is buying opportunities. If you had a lot of cash or still have a lot of cash and you see things like this happen as we go into October, as you could see some volatility there pre-election, it's great buying opportunities. That's exactly what investors should be looking at. Any sort of sell-off, in my view, when you line up the fundamental data, the economic data, kind of the macro lens, of where inflation's going and how jobs look. In addition to strong corporate earnings, Fed rate cuts, I mean, it's a great backdrop. I know that you have an election kind of jammed in here as well. There's always going to be geopolitical risk, for investors. As long as you're a market participant, something that can happen. So, a lot of good things to be excited about. I know the news doesn't necessarily portray it that way. But like I said, I don't know how one can argue recession when, we basically have max employment, corporate profits are fantastic. That's about to cut rates and continue that rate cutting cycle for the foreseeable future. So really good backdrop to me. Not sure why, the market continues to have this whipsaw effect. Just as we're sitting here talking today, we had all the major averages up pre-market, and now across the board, all of them are down, about at least half of 1% or more as we're talking here. And that is before tomorrow's Fed meeting, which is very likely, to be pretty bullish for investors. So we'll probably get it all back. It seems like that's the flow of the market these days. We'll see how things change tomorrow. Is we get one really good day followed by a day where we give away most, if not all, of those gains, followed by a good day, followed by a bad day. So all of this back and forth seesaw effect that you're seeing in the market here makes it a little bit fun, especially if you're looking at it through the right lens, like we try to do from a historical perspective, and take advantage of some of the volatility. But it's also not fun from an emotional standpoint. I can think of a lot of things that people could do other than what I do to make a living for themselves with a lot less stress. But this is the skill set that I have here, so I'm enjoying it quite a bit actually. You can literally see a live autopsy of human emotion every single day, and when you get to wrap around some of that historical probability information with what you're seeing here, I mean, I just get excited. It just provides me with a bunch of opportunity for my clients. So with that, Ez, that's pretty much in a nutshell everything that we wanted to get into here today. Anything else that we need to inform viewers on as far as upcoming scheduling is concerned?
I don't think so. We're still on track for the, two podcasts a month, two kind of major addressing of all the, topical financial news and historical precedent and data that we're looking at. So I can't think of anything on our books that we need to look out for. How about you?
No, I think we've covered most of the stuff that we wanted to cover here. I mean, we got a lot to look forward to. So for the
Oh yeah.
remainder of the year, for fans of the show, fans of the program, and current customers, um, just a ton of stuff to get excited about. A lot of things that we have to pay attention to. The data does need to come in our way. Not saying that all this stuff is etched in stone. And again, past performance is no guarantee of any future result, and circumstances can change. Investing always involves risk, but if you have a long time horizon and you understand, the stuff that we're talking about here today, it's just a really good backdrop to want to be bullish. And if you haven't been able to participate in the market for whatever the reason is due to your lack of understanding or just some fear that you have going on, hopefully, the way that we've laid this out kind of helps put some of this stuff into perspective and makes it less emotional. So the more that you can remove emotion from your investing decision making equation, uh, very likely the more success you're going to have more consistently over time. So that's the goal here for this show. It's certainly a goal that we have for our own customers. Um, and please take advantage of the information that you're getting here from the show because, like I mentioned, part of the reason why we're investing the way that we are has everything to do with what history has to say. If you look at small caps year to date, I mean, it's certainly underperformed. Large caps, by a pretty long shot. Large caps being up double digits and small caps from the mid single digits. Why are we heavily investing in that? Why do I personally, as a disclaimer, have 100% of my own personal money in small caps right now? Even though it hasn't really done anything, it has everything to do with what history has to say about the markets in this specific time that we're in. When we get rate cuts, generally speaking, small caps have always sort of led the way, both on a short term and a longer term basis as we go through that rate cutting cycle. And I will continue to diversify around that, but I'm going to wait until we actually get that pop that I'm looking for here as it relates to my own personal positioning, which is for me, not for customers. It certainly do not have, any one customer in 100% of anything. But given the research that we've been able to do here, my time horizon, the risk tolerance that I'm comfortable with, I'm happy to do that because I think it's the right thing to do here between at least now and the end of the year. We'll kind of reevaluate things from there as we kick off this rate cutting cycle. So hope this was helpful. Hope you're getting a lot out of the program. If you are, definitely give us a like and subscribe. Love to hear your questions and comments. You can leave them directly in the chat on the YouTube channel. You can certainly go to shepherdwm.com. Whole bunch of ways to get a hold of me, learn more about myself, the company, what we're here to do for our customers. And as mentioned, we try to do the podcast about every 2 weeks. So a couple weeks out from today, we'll be doing this again in earlier part of September, be right before the next Fed meeting, looks like.
Mm.
So stay tuned to that. I'm sure we'll have a lot to talk about, given that we'll have all this information that we're excited about for tomorrow. We'll have all the NVIDIA earnings and kind of the impact that that's had on the market. We'll probably have had the new jobs data. So, just stay tuned to the show. We'll have even more to talk about a couple weeks from now.
Not to
But
mention all the
between,
ridiculous pop-offs that are going to happen with the election between now and then.
yeah, basically after Labor Day, you start to get blasted with all the
Ugh.
commercials. Can't get away from it. So just sit back, relax. Football season's upon us. And by the time we do this again in a couple of weeks, there'll be so much to talk about. We might have to extend the program or slice it up. Do like a show one day and have to follow it up with another 30 minutes the next day or something like that. I'm not sure.
Oh yeah, our first back-to-backs. That could be wild. That'll be great.
Yeah, yeah. So we're more excited about the next podcast, even the one that we got through here today, because of all the things that are getting ready to come out here. So I'm excited about that. Can't wait to share it with everybody. Hope you guys have a great rest of your Thursday. We'll see you again in a couple of weeks. Take care.